Okay, so this is early. Fuck. All right, so let's just pull up Spy right off the bat. We can get through it. So, good morning, all that other jazz. We had in June, I think the last time I did one of these, we had a nice little rally, you know, call it 17% or something like that on the S&P. I think it was more than that. I think it was like 20 because I think they count uh, the exact low. But anyways, 17, 23%, depending on what you use, depending on what index you use, depending on all that stuff. And then we failed right at the 200 day. So we have essentially like an indigestion period, and you have this push pull and this struggle between bulls, bears, all that crap, right? And the struggle basically is you have the Fed that raises, and they don't want to raise too aggressively and too quickly. If they do, they run the risk of sending things into a spiral. And if they don't raise, then you have the problem with inflation continuing the way that it had been going. Now, we've talked before. We said nobody wants to be the bad guy. Nobody wants to be the guy that's remembered as um, the person that's going to shut off the lights to the party and all that stuff, right? So we've talked about this before, but we have a problem. Like essentially, we still have like the reality of what is on the docket. So the market still has priced in more hikes to 3.5%. We're at 2.25 now. All these people are going to come out and talk. If they are a voting member, they generally are going to be less hawkish. And if they are a non voting member, they get the ability to have their cake and eat it too, basically, right? So they're able to come out like Bostic and say, hey, right now I'm at 50 basis points, but if I'm not opposed to 75. Kashkari can be a little bit more aggressive, and all these other guys and girls can be aggressive if they don't have to actually vote, because it doesn't fucking matter. They can say whatever they want to say, right? Like they can come out and say, "Hey, we should raise 3% in one strike." It doesn't matter. They don't actually have a say in the matter. So that's issue number one. Issue number two is historically speaking, when you have a setup like we did on the bearish side, essentially you run the risk of sending the markets into a recession, and that risk is generally high. Secondarily, if you have these technical situations where when more than 90% of stocks trade above their 10 and 50-day moving averages simultaneously after a corrective measure, it generally signals some sort of bottom, right? So you have all these conflicting messages and all these conflicting situations. But the Fed tells you specifically what it is that they're looking for and what it is that their dual mandate is. Their dual mandate is inflation and employment. And so for a while, once we got to the sell-off, bad news was good news, and good news was bad news. And the reason for that was you needed the Fed to um, not send the rate of change on rates as aggressively as they were sending them. So if you got some bad news on a job front, it told you that okay, then the peak inflation thing, or excuse me, the peak employment thing is cooling. If you got um, if you got bad news on the consumer side, it told you the consumer couldn't spend. So for a while we had that little weird situation, and at the same time we had 10-year, 5-year break evens. So it's a measure of like inflation essentially. Um, they weren't signaling that they were going the wrong way. They were signaling that the Fed might have had control of it. So generally speaking, anything that the Fed does usually takes 3 to 18 months. And that's funny because it's a really wide range, which shows you that like nobody really has any fucking clue how to handle these sorts of things. But you get this 3 to 18 month period where they do something, and then the data shows up 3 to 18 months later that signals the result of what they did. The the outlier to this is when you do something aggressively. So generally speaking, markets are inefficient, but they're not so inefficient that they're way off base by like, 1% or more. So when things happen as sharply as they did, between February and June, it looks like panic, and it looks like the situation is going to be dire and all that stuff. If you look at why we rallied last week, basically we rallied because the opinion that essentially the Fed at some point is not going to raise as aggressively, or they're not going to raise. So at some point down the line, they're not going to raise, which is kind of weird because, yeah, they're not going to fucking raise to infinity. We all know that. But it's just that's how sensitive we got, and that's how bad things got, from a sentiment standpoint. But the push pull is the market is beginning to suggest a 75 basis point hike might be needed, and momentum simultaneously is bullish, and breadth thrust, percent of stocks above their moving averages, momentum indicators, RSI, all that shit tells you that they're bullish, but reality tells you that they're behind the ball again now on inflation. And inflation might not come down as easily as people suggested, or they might have thought, and they might have to act more aggressively. So you get this push pull, and meanwhile they're boxed into a situation where they can't come out and tell you that. Hold on a second, my clock's going. It must mean okay. So they can't tell you that they are going to be as aggressive as they might be until it's time for them to act. So you get this like song and dance, and you get this situation where they're basically kind of stuck in a sense of like, we have to act this way because we are data dependent, but we get this veil and we get this cover to say, hey, we're data dependent as long as you ask us, until we actually have to act, right? And so that's the push pull, and that's like why we're seeing a lot of this. You get a rally, we rallied up to 200-day, we gap down, and now essentially we're filling the gap in the pre-market. What are we at for 420.54 on the S&P? So essentially we got another dollar and a half to go to fill that gap. So like that's the push pull. I personally think from a Powell perspective, let's just go over like some of these quick opinions. I don't think that he's going to say or do anything that's going to suggest that he's going to be overly aggressive. Like I think he has the slack to come in and say, hey, we're going to act as we see necessary, and we're not going to do anything, to harm the consumer, yada, yada, yada. I think that he'll try to thread the needle. Now, the song and dance part of it is, does he actually thread the needle, right? Like that's the first thing that you want to ask yourself. Does he actually come in and have the ability to thread the needle to to the likes of anybody who's trading or investing in this market, right? So does he have the ability to say, hey, we're going to do everything that's necessary and we'll act as accordingly, while simultaneously saying, hey, we're not going to overdo it. And that's the weird part, and that's like the push-pull. Now, when we last had one of these calls, I said, like, I don't see what would possibly push things lower because there was no Fed meeting. There was nothing until Jackson Hole. I also suggested that, like, what is the negative catalyst outside of them? And with oil prices coming in the way that they did, and with material costs coming in the way that it did, and with some of the other things, like I didn't potentially see that the consumer was going to see even more inflation in the summer relative to what they saw in June. So you had this like nice little sweet spot. Now the weird thing and the interesting thing will be whether or not the oil shocks continue, whether or not the consumer gets pinched in the fall. Like you're seeing readings of nat gas, electricity costs, all that stuff in Europe. Like how much of that spills over here, and how much of that do we see coming, in the fall actually. But with all that said, like we're at a situation where I don't think that he's going to want to push. I mean, I could be wrong, but I don't think he's going to want to push anything aggressively. Like, there's nothing that he's done historically that suggests that that's the kind of person that he is. Again, I think uh, Uncle shared it in the bunker. Basically, like the guys who don't vote get the ability to come out and be dicks, and then he gets to come out and save the day, basically, right? So that's the main thing I think to pay attention to. Um, outside of that, you do have month end and you have seasonality coming up. So you have potentially a month end window dressing for the markets coming up in the last week of August. And then generally speaking, September and October are miserable months, especially when you have the market behaving the way that it has behaved all year. I do think though that we might be able to get some pockets of strength and have a situation where you have some momentum names trading. And I know. So I'm gonna go back to the way the chart was. So first and foremost, like we have a run up, let's say to the 430, the 200 day, still be right back in the downtrend. Let's say you got there by September 1st. That's not out of the question, and it would put you right back to a downtrend in the market. So that's first and foremost, right? Let me change this though. I know we only have 13 minutes. So with that said though, like with this headline on US China, I know, Baba, for example, like on the 23rd pre-market, I said it feels like they'll run it. I should have traded it. I didn't. And that's exactly what they did. And so it might feel like, oh crap, we missed the boat or whatever, right? But no, like if you just go back, like this is a 48% return from, the lows in May. And then if you go more aggressively, you can see that it's probably like a 60-some% return from the lows in March. So yeah, so you had a 65% return from March. So just assume that this doesn't stop on the open, and who knows? I don't really do well with China recently, but just assume that it just gets back to that upper range. You have 38% on Bob, for example. And so any sort of consolidation or base can kind of open the door for us from a momentum side. But then you just go cycle through them one by one, right? So like I shared Lee, for example, trading 32.20, closed at 31. 32 is essentially the 20-day. So if it holds this 20-day, get a little range to the 50-day. And then just go cycle through them some more. Baidu's breaking out of, I already had this lined up just to kind of get an idea. So, Baidu from the lows was a 58% return on in May. So I'm not assuming that you're going to get a 58% return, but I just wanted to kind of see if it would put it at a level, and it would put it at 200. So if it got aggressive, that's what it would do. I don't think it'll particularly get that far. I think you could get to what's it at 158. So we could get to probably 167, which is kind of where this breakdown point was, or like 162, which is where this breakdown point was. But anyways, my whole point is outside of like where I can go today, just reset this. Baidu has been in an 15 to 16 month downtrend, and it just broke out. So like, yeah, you might get some momentum in the next couple of days, months, weeks, whatever. And so there are some things that will still come of this, as long as these guys don't act chaotically or aggressively, in an unexpected fashion. Outside of that, let's just do JD real quick. It's going to open basically right at this resistance level. Peaked out at 69 twice here in March. I think we traded that one back then. And then we had PDD. This one was the leader early in the month. And it should potentially get to like this 67, 68 level if they get a little aggressive. Or, even if it got 65 installed, it's not a big deal. My whole point is, if these things are not momentary and they don't fade in the next 2 days, and they give you a little bit of base, we do have potential to see some outperformance, especially with how much underperformance has happened in China in the last few years, few months at least, right? So that's kind of like the logic on where we could look for on a momentum side. But the whole point with Powell is I don't potentially think he's going to say anything to harm the markets. I don't think he's going to be aggressive. I think he's going to be able to try to not be able to, but he's going to try to thread the needle between saying, "Hey, we're going to do what's necessary, but we're not going to overact." Yada yada yada. But doesn't mean he can't fuck up. So should he say something too dovish? I think that's actually a bad thing because people will read through it eventually and say, hey, they're walking back what they said. They're being wishy-washy. If he's too aggressive, same kind of thing, but I don't think it'll be a wishy-washy thing. It'll just be like a fear, right? It'll just be, are they going to push us into a recession? And then what I think he's going to try to do, and I think ultimately it'll probably be received that way in the short term, is just say, hey, we're going to be data dependent. Data suggests we got to do this, and then we're going to do it. If it suggests something else, we're going to do that. And in the short run, I think you'll not see panic. But I've been wrong before, and so it's good to just have in the back of your mind the potential outcomes and just kind of go off of them. Just give me 1 second. Yeah, so the main thing here from a rate perspective is, again, not the one. Let's close this one out. They got to get the 3.5 or more, right? And we're not anywhere. We're not there yet. So if they're going to get to 3.5, it's just how fast are they going to get to 3.5? And if we just remember, it's not the rate itself that matters. It's the aggression or the velocity of the rate. So if they're not going to be as aggressive and they're going to kind of slow and steady have it happen, and inflation's going to come in, then everything's fine. But if one of those inputs in that function changes, so if they have to be more aggressive to combat inflation, then you might have a situation. Secondarily, whatever data that we've seen or we're going to see from where rates are currently versus where they were 3, 5, 6, 7 months ago is not something you're going to see in the next week or two. It's something that we're going to see in the next couple of months at least. So it's important to remember that, so it can kind of temper a little bit of the expectations, and so we don't get ahead of ourselves, basically. So I just wanted to kind of put that out there. If you have questions, just ask me using the questions filter. I don't want to keep talking. So we got 5 minutes. Essentially, you don't want to, jump the shark early. You want to just kind of go through it, let him say what he has to say, and then react to it. If it's too aggressive, the market's going to sell off. If it's too dovish, market's going to panic and think they're going to back off. And in the latter, I'd look to like materials and to oil names, etc., boomer names basically. And in the former, I'd look to like banks, and just overall risk off dynamic. And if he's able to not be a dick and just kind of do the echo chamber thing that he did a month ago, I think people are just going to kind of go, okay, we got through it. Now let's just get through the end of the month. So we'll see. I've been wrong before, but that's just kind of my read on it currently. All right, I'll see you guys in a sec. Can y'all hear me okay? Let's see. All right, cool. So I want to do this before we break down because we're going to break down again. But basically, I didn't think Powell on the front end. I didn't think Powell was going to be as aggressive as he was today, right? So in the morning when I had the live. I said I didn't think that he would be aggressive. I thought that he would just kind of toe the line that he did last time with being data dependent. But he didn't, right? So he came out and just basically put a stop to everyone's thoughts of a potential pivot at some point, right? And so a couple things. First things first. Excuse me. I'm sorry I did that. First things first. Inflation break-evens we talked about on the front end being a harbinger for the Fed. So, he noted that. He noted the imbalance in the labor market as well. He noted that inflation is being stickier than they expected. And a couple of things that he said that were newer that kind of like rattled people in general. One is that households are going to suffer. Like literally said, hey, people buckle up. It's going to get bad. And then also said that the idea that they're going to pivot anytime soon is not real, basically. So essentially, we've had 13 years of the Fed basically talking tough, and every time something gets bad, they come back in and they say, hey, our bad, not going to be as tough as we thought. So for 13 years, people, us included, have been conditioned that when you think things are going to get bad, they don't actually get bad. They pull back the reins and they say, hey, you know what? Actually, let's not get that aggressive because it's going to hurt the economy. This is the first time that I can remember where that wasn't the case, where he just decided, because usually, we had a joke earlier in the morning, Uncle and I were saying, it's like a tongue-in-cheek, but not really, like it's a real thing. Basically, for the last 10 plus years, you'd have the guys and girls that can't actually do anything come out and say things that are negative, and then the people that actually can vote will come out, Powell included, and assuage the market. But this is the first time that they've kind of been in lockstep for more than just one meeting, apparently. So those are the two things that were really like stuck out to me. So basically, Powell had to toe the line. He had a choice: toe the line or basically give the market the medicine, and he chose to give the market the medicine. So the couple things that we gotta like take away from this is, one, this time it's different. So, prior we would have same old, but this time it appears that it's different. You also have Biden earlier in the year saying that he's going to back off and let Powell do whatever he needs to do. At the time, we joked like, hey, this is an easy way for him to say, hey, this is not my fault, look what they're doing. Could be the political side of it. But also, like, this is the first time in 5 years where they kind of have carte blanche to do whatever it is that they need to do. Remember, when Trump was president, anytime they needed to act, he would go on a temper tantrum. So that's the first thing. Second thing is, so because of this 13-year conditioning cycle in the market and in people who invest and trade, we have a situation where that optimism that people have built up, and that rapport that people have built up over the last 10 plus years, it has to break. And that breaking process is not easy, right? So it's a process. It's not an easy one. And so basically, I don't know when people will start taking things a little bit more seriously, but they're going to have to. And I think that's going to materialize in earnings. So in this morning's session, like if you remember, it takes 3 to 18 months, depending on what happens, for whatever the Fed does and whatever actions that take place to show up in actuality. And so if you just think of it like that, then what we've seen already isn't anywhere near as bad as it could possibly get from an actual data perspective. So that was the push-pull. So you have this data that's coming that is going to be bad, but you have wildly bearish sentiment, you have historic short positions, and then you have just like a momentum market and this optimism that maybe they'll back off, maybe they'll pivot, right? So like the last time they had the meeting, everyone here, we didn't particularly see the pivot, but anywhere you went on FinTwit, pivot, right? And that's not the case. And so today he just basically hammered it home and said that's not going to be the case. And so when you put that in a picture, basically the market was off sides, and they believed that the Fed pivot would be coming, and it would be coming sooner than it actually will be. So if you take a look at like the chart this morning, let me see if I can do a 5-minute. I'll show you. You can see a 5-minute on Tesla. I know because I was watching that one, right? Well, I don't need to. So you see it here, right? And so, all right. Well, Nvidia's breaking down. You see it there, right? So for a moment, he mentions that a pivot would come over time, but when he sobers the reality and says, "Hey, it's not going to come anytime soon," and that we can stay higher for longer, people panic, and they rightfully panic. Like it's not a, I don't even think it's panic. I think it's just like things need to be priced back the way that they were, or the way that the reality should be, right? And so when you put it in that framework, when you think of it in that framework, you'll understand that the market was offsides, and Powell made it very clear that it's not in the cards at any time soon that they're going to pivot, right? And so the last part is, and I covered it really briefly on the front end, but multiple other non-voting, I want to emphasize on the non-voting, have been in the higher for longer camp. It's just a matter of this conditioning that we've had for the last 10 years where you'd have these non-voting members say something, and then you'd have the voting members do something different. And so it's, if they're going to be data dependent, which is what they say they're going to be, and their mandate is to keep basically peak employment and low unemployment and return price stability through inflation with their 2% target objective, which is like it's not going to happen anytime soon. Then it's not like data is telling you that they can back off anytime soon. And so it was kind of like a welcomed sight to see that he actually, for once, was doing his freaking job, versus the past when, he wasn't, right? And so now we're going to get to a point where it's like, what is the next shoe to drop, right? And what is the data that we got to look for? So in June, when everything was as bad as it was, bad news was good news because it made people believe that the Fed would back off, right? So if you got unemployment numbers, then people were like, "Oh, okay, cool, unemployment, so the Fed can't act." If you got, it was just backwards. But now I think moving forward, you're gonna have this really interesting dynamic where like certain information, certain input that is bad news will be good news, and certain input has to be good. So just take a look at like jobs, for example. They want the labor market to basically flatten out and be equal. That's something that he basically said. There's an imbalance in the labor market. So when there's that imbalance, they want that balance to level out. But also, you want people to buy less shit. So you need unemployment on a low basis. You don't want it like on a, you don't want it on a mass scale. But, unlike June where people are like, any unemployment's good, this time around, I think that the unemployment that you're going to see is actually going to be detrimental because it's going to be an economic impact behind it. It's not like June where like people had their vacations planned and they had all this stuff. So that's one. Two, if you take a look at like what people were spending their money on pre-reopen and now post-reopen, people are spending their money on a lot of experiences. So if we're going to go into the fall and more people are going to have less and less money, and more people are going to have fewer and fewer jobs, and more people are going to need less and less shit, even if they start spending that money on experiences, by and large, most of the experience high-ticket items have already been purchased. And so in the fall, there's going to be an expectation going into Christmas especially. I know I'm talking really early, but like there's an expectation that if they don't spend that cash right? So like if people don't have money to spend, or if they don't spend money on goods, then you're gonna have a situation where the already elevated inventory that we're seeing for some of these retail companies will remain elevated. And then how do you think that spills over? It spills over into the spring, where those companies still have this inventory build, and they went ahead and tried to prep for a Christmas situation, try to prep for a seasonally strong sales period, and they couldn't offload that inventory, so now their inventory increases even more, which would lead to like even more bumpiness into the spring. So like these are the domino effects basically, right? And these are like the log jams that could, and I emphasize could, pop up, in the next couple of months. The other one's obvious, right? So it's Russia, Ukraine. Everybody who's turned from virologist to macro econ guy to war expert to Russia Ukraine expert has been telling anybody who'd listen from the treetops that they kind of figured it out and that things are going to go higher. I don't know. Like I stay in the camp that I'm not sure. 1 second, please. Excuse me. I need some water. I don't know. I don't have a crystal ball of how it plays out. I personally, because I've seen it before, believe the pain trade is just a sideways, volatile extremes on both sides. So you get a ramp up in energy prices on one side, and then a comeback on the other, and it just kind of eats people in general across the board. So that's kind of like my opinion. I haven't changed my opinion on that. I haven't seen anything to materially say that that's going to change. Because I do think at the end of the day, it's a dual-sided equation. Like Russia still needs to export, and Europe still needs to import. So they could talk tough all they want, but like, for fear of destroying their own benefit, they'll probably find some sort of balance. So the balance could be higher, like on an average basis. So you could have a higher level be the balance. So instead of let's just pull up crude just to kind of talk through it. So you could have a situation where you stay at or around this $95, 95 to 100 basis on crude, or even like 95 to 105, and that stays in a range, but it's still elevated enough to where these oil companies still profit. And then the big one is nat gas, right? So in nat gas's sake, electricity expenses they're already through the roof in Europe, and so this belief that how are they gonna get through it, right? I don't know. I don't have the answer. It could be a situation where that does materialize, but again, this is another cog in the wheel. This is another problem. This is another thing that the market has to get through, because again, if people have higher input costs and companies have higher input costs, then they got less money to spend. It's just literally that simple. And then the last domino, and I'm going to make it real quick, but the last domino that we're going to probably think of here in the next couple of weeks to months is going to be housing. So the Fed last week basically told us that they're going to tank the housing market. They just outwardly said that people have a lot of equity in their home this time. It's not like the last time. And because they have equity and because they have these fixed loans, that they could see more downside and they could experience more downside and still be fit to experience more downside. So they're basically telling you, hey, we're going to tank the housing market. We're going to do whatever it takes on our end. Whatever happens, happens. So at this point, we just need the market to start believing some of the reality that's in front of us. And, if that means, let me just erase this real quick. If that means that we went and tested the 200 and then we just rolled over, and then we just keep rolling over, then that's what that means. If that means that, again, that we get some sort of window dressing into the end of the month, just to kind of clean things up, and you just oscillate between this 100 and 150 and 200 EMA, then that's fine too. But the reality is September historically is a bad month. October is historically a bad month. What are the catalysts? You got to just constantly ask yourself, what are the catalysts that's going to drive things upward and not downward, right? And so when you see a large break like this that's happened today, don't rush out and be the person that's like, I need to go buy the dip now, right? That shit that's happened in the last 10 years, conditioning, just throw it out the windows. If you don't know how to do anything, you're better served just letting them sell it off. Let them sell it off to extremes. And again, if this year showed you anything, and if I've showed you anything this year, we wait for the extremes, up or down, and then we back off. So, when we had June and everybody was bearish and the sky was falling and oil was at 124 and Russia, Ukraine, and CPIs at 9, and like everybody, that's all anyone wanted to say. When you go on Twitter and at the top of the page, all you see is fire alarms, fire trucks, and the sky is falling, and you see that for a week straight, you know the bottom's coming. And the opposite is true. When you go on Twitter and it's just green shoots and everybody's talking about in their plays of the week how bullish they are, the opposite's probably going to happen. And so even if you don't do anything, even if you just go, hey, you know what, I'm going to back off, then you back off, and you're going to get those extremes. That's the kind of market that we're in. We have too many really weird exogenous variables that don't usually go hand in hand that are going hand in hand. And so those are the things that I want to watch for here in the next couple of weeks, months, whatever. I do think that we're going to probably sell off into the close and probably end the day right on Monday, and then from there we'll see. But don't be a hero. Don't go into things thinking that you have any impact or any edge beyond just understanding that there's reality that we have to digest. If you miss something, don't panic, right? If you bet on something and it doesn't go your way and you're wrong, don't panic, right? Don't do the dumb shit that I did yesterday where I fucked up and I averaged down yesterday to battle my way out. Don't do that, right? Like I fucked up, shouldn't have done it. I got out flat, but don't do it because like just mentally it's not worth it. I see a question from Jay Diddy. Are you interested in going long on selling micro minis for the overnight? Not saying now, but do you see safer? So I don't like to sell until you get to extreme. So if you get to an extreme, so like again, if you go back to this June 14th to June 21st, go back to that period. You had 98% of stocks below their 10-day. 98% of stocks below their 50-day and 99% of stocks below their 10-day. That's an exogenous extreme, right? And so in extremes like that, if I want to start selling stuff and owning it, then yeah, sure, I'm happy to. But I don't like to sell on day one. The thing that you could do is you could, now that you know that 430 is your bogey, if I was one of these people that like to sell premium, I would probably sell premium above this 430 level for the end of the month. Because, what's the headline? Like, the Fed over the weekend is just going to randomly, cut interest rates? I doubt it, right? And so that's essentially like how I would do it from a premium perspective. But JPow's right. JPow Jr., that is. If you miss something, don't worry. You got tomorrow, right? You got a day to absorb it. You got a weekend to absorb it. Don't worry. The worst thing that you could do on a Friday especially is chase yourself into a hole and not have to sit all weekend and think about it, right? So I've been there. I do it all the fucking time. So worst thing, it's the worst feeling. So that's just kind of like the thing. If things flatten out later in the day, like in the next couple of hours, and I've got like another input, I'll fire another one of these up. So if you got questions, just put them in here. In this, there's a bunker. There's a bunker. Here, let me see if I can pull it over so you guys see it. Problem is, if I do this, it might just be like an echo thing. So there's a bunker in this, right? So there's in the voice channel, if you click here, if you click that, it opens the chat, right? So you can easily just kind of go through and fire that up. So yeah, so if you have any questions, send them my way in the bunker chat. You can also just put them in the trade questions. It's not a big deal. Yeah, but I'm gonna get back and just kind of watch and see what's going on. So we're at 311 on the Qs. We broke 410 on the S&P. So we'll see what comes of it. But just don't panic and don't do anything dumb. Like don't feel like you missed something. If you've missed something, it's fine. Tomorrow the market opens again, right? And then next month, this time, you also got another one of these to go with. All right, guys, I'll see you in a bit.